Singapore GRMs are mirroring the massive fall that we've seen coming in the crude prices and hitting the lowest levels as recession fears are actually rising in as well. Now, let's go across to Somit, actually standing by to give us why is this happening, the reason behind this, and the stocks that will be in focus on the back of this crash today. Somit?
Well, if you see, the Singapore gross refining margins have been trading around the negative territory for quite a bit now. In fact, right now it's trading at around negative $0.1 per barrel. Now, it had touched its peak on June 21st, hitting the mark of around $30.5 per barrel. And since then, we have been continuously seeing a decline in the Singapore gross refining margins. Now, three reasons behind this. Firstly, the recession fear. Second is the softening demand that we have been seeing. And third is the fact that China has released additional export quotas of around 1.5 million tons, which means that additional refined products will be in the market. And these are the three reasons why we have been seeing such a sharp decline in the Singapore gross refining margin. Now, what is the GRM? GRM is what an oil refiner earns from converting every barrel of crude into a refined product. So, which companies does this impact? Firstly, it impacts the pure play refiners like MRPL and Chennai Petroleum. Then there are oil marketing companies like IOCL, BPCL, HPCL, and then there is Reliance Industries, which also gets impacted because it has the largest refining unit in India. Now, a negative gross refining margin means that the oil refiners are earning losses by converting every barrel of crude into a refined product. Hence, we are seeing a sharp fall in the pure play refiners like MRPL and Chennai Petro. Now, for oil marketing companies like Indian Oil Corporation, BPCL, and HPCL, if you see a sharp drop in crude prices, in fact, is a positive because of this. They have started earning a good amount or lower losses or a good amount of profit by selling every liter of petrol and diesel. Now, earlier they were making a losses of close to 15 rupees on selling every liter of diesel. Right now, the losses have come down to only 5 rupees, while on petrol they are earning around 11 rupees from a losses of around 5 to 6 rupees that they were incurring 2 months back. So, for oil marketing companies, a sharp drop in crude prices is positive, though negative GRMs will impact the refining margins. But when it comes to pure play refiners like MRPL and Chennai Petro, a sharp drop in Singapore gross refining margins will definitely impact the financials going forward.
Okay, Soma, thank you so much for putting it into perspective. So yes, commodities coming under pressure. Crude prices have come down to $85 to the barrel, and GRMs as a result of all of this is in the negative territory, not to talk about the demand fears that we are seeing on account of recession. Let's take the discussion forward with our guest on the show then. Kunal Bothra, as always, joins us for a technical check on the market, and Ashish Maheshwari, the director at Blue Ocean Strategic Advisors Private Limited, is also on the show with us. Ashish, first coming to you. How does one play this entire theme of crude coming off, GRMs going into the negative territory, and a view on the entire sector?
Sometime GRMs are hovering around $3 per barrel from $30 to $3. It came down in just last 3 months, and right now as they have moved to negative territory. Again, the reason is as the rate hikes are going to take place, like the fear of recession is building up, not only in one or two economies, almost in every economy, first of all. And in my view, till the time this interest rate hike cycle will continue, crude cannot go up because now central banks are cooling down their economies and trying to bring down consumption. So my idea will be though these negative GRMs are not sustainable for long because OPEC and other OPEC plus countries will try to curtail production and will try to maintain some margin. But I think $2-3 per barrel is a reasonable margin. But the problem is these kind of margins are sustainable for or are going to be a trend for at least now for 6 months because interest rates are not going to come down for sure in next 6 months till the time inflation cools off. So, the major turmoil will be there in crude market, and we are witnessing that also. And it will affect Reliance Industries because they are one of the biggest refiners and had enjoyed even $35 a barrel in the last quarter. And this quarter, if they'll just do $1, significantly we'll see dent in the profitability. Ditto for MRPL, ONGC, etc. Even BPCL is also into refining, so some effect is going to be there. So negative for oil refiners, this particular development, and I think this will continue for some time. So let's not be in haste to buy these stocks looking at the fall which is coming.
Okay. Thank you so much for that, Ashish. That's the fundamental side of the view coming in. But Kunal, coming to you, obviously, Right now, Ashish was also mentioning how it affects, Reliance coming in as well, ONGC, the oil marketers as well. Now, how are you looking at the charts for this one? Any specific company that you're looking at then in this space?
So Reliance is what I've covered up, for this discussion, and the charts are at a point where the stock has come back towards a major support point for itself. So when I look at it from the June lows, the stock has come back towards the 2350 mark, 2400 levels. When I look at it over the last 2 years for Reliance Industries, the stock has come back towards a major trendline support. Now this is going to be a big trendline support for Reliance Industries, but if the stock is able to break below this support point, it could be a big breakdown for the stock price over the near term. So we'll wait out for a point where 2350, 2360 could be a good support for Reliance Industries. But if the stock breaks below those support points, we could be, or the charts could be signaling that the stock would now get into a major downward trend, possibly even a 5% to 10% kind of a correction below those levels could be something which you can spot on the stock.
Okay, so that's the word coming in on Reliance.